If there is one thing I regret spending my time on is indicators. Technical indicators are no doubt a huge topic in trading the financial markets. They can range from a simple moving average to a complex array of algorithms. It doesn't matter whether you're trading stocks, commodities, futures, or any other market, technical indicators are common. But are they useful? Well, let's see. Think about it for a second. With an infinite number of indicator combinations, how on earth are you supposed to find something that works? I have been trading for 5 years and I never understood why people kept on trying new indicators almost every week. So, I concluded that people do change them like socks because they simply don't work. Everything I need to trade successfully is already on the chart. It has been the whole time. I don't care about any fancy secret indicator, and I don't care how much you paid for it, it is still lagging. I use only price action. Price action trading is a method of day trading where traders make decisions about trades based on price movements rather than on indicators derived from technical analysis. I trade the ES futures on a 2000 tick chart, and I have my 21 EMA on a Japanese candlestick chart. That's it. The 21 EMA acts as my dynamic support and resistance, and I don't need anything more to clutter my chart. For me, the only things that matter are my trend lines, my channels, and my naked chart. The price displayed on a price chart at any given time represents the collective beliefs, knowledge, and actions of market participants. If prices are moving up, it implies buyers are in control, whereas, in declining markets, it means that sellers are running the show. In a sideways market, there is no consensus between buyers and sellers. That's all I need to know, and I see no reason to overcomplicate it. I have a simple scalping strategy that works well in the mini S&P, but will actually work in all markets. This technique is based on a price action pattern that I use. Unlike other price action traders, I don't scalp the market for a few ticks. It makes no sense to me. In my opinion, this whole idea of scalping the market for a few ticks is all based on fear. My system is based on scalping with risk to reward ratio of at least 1-to-1, allowing me to enter and exit the market in only a few minutes at the very most. It has a good high win percentage and can be learned by any level of trader who is willing to work hard. My strategy is all based on the two-legged correction, which is a continuation pattern in a trending market. In general, most losing traders look for tops and bottoms, while in fact they get tricked and enter with the correction when in reality they should be entering with the trend. This pattern works against most traders, as it lures them to enter counter-trend as they are wrongly looking for these tops and bottoms. Most losing traders don't see that the problem lies in that these two-legged pullbacks look more like a topping or bottoming action, depending on the trend direction, so they fool the weak traders that do not understand how price action works. That's all I need to take advantage of this pattern.